Imagine waking up tomorrow and realizing that most of your financial decisions were never really yours. The job you chose, the house you thought you could afford, the credit card you used last week, all of it quietly influenced by a system designed decades ago. A system built by banks, governments, corporations, and financial institutions. A system so powerful that it shapes how billions of people earn, spend, save, and invest their money. But the strange part? Most people don't even realize it exists because it operates silently in the background of everyday life. This is the hidden system that controls your money. And once you see it, you'll never look at money the same way again. Part 1. The system begins. To understand this system, we need to go back more than 100 years. In the early 1900s, the world economy was unstable. Bank runs were common, financial crashes happened frequently, and entire economies could collapse overnight. So governments and powerful banking leaders decided something had to change. In 1913, the United States created one of the most powerful financial institutions in the world, the Federal Reserve. Its job was simple on paper: control the money supply, stabilize the economy, and prevent financial disasters. But what this also created was a centralized system capable of influencing the entire global economy. Because when the Federal Reserve moves, the entire world moves with it. Part 2. The power of interest rates. One of the most powerful tools in this hidden system is something that sounds extremely boring: interest rates. Yet these tiny percentage changes affect nearly every financial decision in your life. When central banks like the Federal Reserve or the European Central Bank change interest rates, the effects ripple through the entire economy. Lower interest rates mean cheaper loans, easier mortgages, more spending, more investment. But there's a catch. When borrowing becomes cheap, people start taking on more debt. They buy bigger homes, more expensive cars, and take out loans they normally wouldn't consider. This fuels economic growth, but it also quietly locks millions of people into long-term debt that keeps the system running. Part 3. The debt machine. Debt is not just a side effect of the financial system. In many ways, it is the system. Think about it. Most money in modern economies isn't created by printing cash. It's created through lending. When banks issue loans, new money effectively enters the economy. This means economic growth often depends on people borrowing more and more. Mortgages, student loans, car payments, credit cards. The average person may spend decades paying interest to banks, and this is incredibly profitable. Global banks collectively generate trillions of dollars in interest payments every year, because once people enter the debt cycle, escaping it becomes extremely difficult. Part 4. The lifestyle trap. But debt alone isn't enough to keep the system running. There's another powerful force involved: lifestyle inflation. As people earn more money, their spending increases. A promotion leads to a bigger apartment. A salary increase leads to a nicer car. A raise leads to more expensive vacations. Slowly, the cost of someone's lifestyle rises to match their income. And suddenly, even people making 6 figures feel financially stressed. This is sometimes called the middle-class trap, where people earn enough to appear wealthy but remain financially dependent on monthly income. And corporations know exactly how to encourage this behavior: advertising, social media, status symbols, all designed to push consumption higher and higher. Part 5. The consumer engine. Modern economies rely heavily on consumer spending. In countries like the United States, consumer spending accounts for nearly 70% of economic activity. This means the entire system depends on people buying things: phones, clothes, cars, subscriptions. New products constantly appear, promising convenience, status, or happiness. But most of them have something in common: they slowly drain your financial resources. And because people spend most of their income, very few build real wealth. Instead, money circulates upward through corporations and financial institutions. Part 6. The wealth gap. This is where the system reveals one of its most important patterns. While most people work for money, the wealthy own assets: stocks, businesses, real estate, investments that generate income without constant labor. Over time, assets tend to grow faster than wages, and this creates an expanding wealth gap. For example, global stock markets have historically grown around 7 to 10% annually over long periods, but average wages grow far slower. This means people who invest accumulate wealth faster than those relying solely on salaries, and the system quietly rewards ownership over labor. Part 7. The financial education gap. Here's the surprising part. Most people are never taught how this system works. Schools teach algebra, history, science, but very few teach how money actually functions. Things like compound interest, investing, inflation, asset allocation. As a result, millions of people enter adulthood with little understanding of financial systems. And when people don't understand the system, they become easier to control by it. Part 8. The inflation effect. Another powerful mechanism inside the system is inflation. Inflation slowly reduces the purchasing power of money. In simple terms, the same amount of money buys less every year. A meal that cost $10 20 years ago might cost $25 today. A house that cost $100,000 decades ago may now cost $500,000. This means people must constantly earn more money just to maintain the same lifestyle, and this pushes people to work harder, longer, and more consistently, while assets like stocks and real estate tend to rise alongside inflation, again benefiting those who own them. Part 9. Breaking the cycle. So if the system is designed this way, is there any way to escape it? Actually, yes, but it requires understanding how the system works. The first step is shifting from consumer thinking to investor thinking. Instead of spending every extra dollar, many financially successful people focus on acquiring assets, investing in stocks, buying income-generating businesses, owning real estate, assets that produce cash flow. Over time, these assets begin to work for you instead of the other way around. Part 10. The real power of money. The hidden system controlling money isn't necessarily a conspiracy. It's simply how modern financial systems evolved. Banks profit from lending, corporations profit from consumption, governments manage economic stability. But individuals still have choices. The key difference between those who struggle financially and those who build wealth often comes down to one thing: understanding the system, because once you see the patterns, you can start making different decisions that move you from being controlled by the system to benefiting from it. Outro. The truth is, money has rules. invisible rules shaping the global economy. Most people spend their lives playing the game without ever learning the rules. But once you understand the hidden system behind money, you begin to see opportunities everywhere. And the question is no longer, why is money so hard to manage? The question becomes, how can you make the system work for you? Because the people who truly understand money are the ones who quietly build the most wealth.